In the previous couple of lessons, where we've been essentially looking at a few more of the, I guess you could call them the more basic components of market structure, one of the sort of powerful concepts that we looked at was changes of character. So not only looking at those major breaks of structure on those major swing highs and swing lows, but also looking at the breaks of those minor lows and all of the internal structure that's stuck between that swing range, right? That any structure or price action between the swing high and between the swing low is essentially that internal structure, those substructure breaks and those minor breaks of structure. So when we have a bullish trending market, for example, and we have a swing high, a swing low, and then another swing high up here, right? We don't have to wait for price to pull back before potentially looking for a trade. What we can do, or well, we don't even have to trade it, but we can also just use it to anticipate what's happening next, right? And if we see something like this where we get that minor break of structure and we see that first initial change of character, right, where we get that first minor lower low and then that minor lower high, right, that can then signal to us that this swing run is now over and the pullback is about to commence. Now, we never know how far price is going to pull back, or even if that's actually going to go and reverse and cause a swing lower low, right? But we can use those minor structure breaks and that internal structure changes of character to sort of give us an indication of what may be happening. So change of character is essentially just one sort of tool on its own. So in this case, one of the examples that we looked at before was where we see the initial change of character, we see that initial minor low get broken to the downside, then we get a series of lower lows and lower highs, right, with the internal structure. And then price breaks up, we get that minor break of structure there, we get another change of character as price now forms that first higher high again after a series of lower highs, right, showing us that some bullish intent has come into the market, right, that some money has stepped in to break this series of lower highs to give us that higher high. So we can use that as a signal that potentially the swing higher low is now in place and potentially we are about to start the next bullish swing leg to make that higher high, okay? But as we were looking at, right, sometimes it can be a full signal, it can be a short-lived bullish move, and then price can, again change character to the downside. So that series of higher highs, higher lows, and higher highs is suddenly broken again. We get that lower low. So that first lower low again is that next internal change of character, right, to the downside, which then gives us another signal and a warning that, okay, actually this low is now going to get run. This is not going to be the swing high low, and actually we're likely to pull back deeper, right? And then we pull back deeper, and then in this case, we form that lower low, lower high, lower low, lower high, lower low, and then we get that break of that series of lower highs to form that next higher high, right? We get that internal change of character. And again, this may be another signal that the pullback now has finished, that the higher low may be in place, and then that pro trend swing move has about to commence with the first minimum target of breaking that weak swing high, right? So change of character, I guess, is one tool that we can use to help us identify that a swing run is ending and that a pullback is starting, and that when the pullback may be finished and this next swing leg may be starting, but sometimes it can give us false signals. So there's quite a few things that we can do, quite a few concepts that we can look at and introduce that can help us to potentially stay out of getting trapped and trading these false signals, and increasing our probability of only trading the moves when they're actually going to play out. So essentially increasing our strike rate. Now, one of those concepts, as you probably guessed by the title of the video, is the idea of premium versus discount. So like I was saying, there's many things that we can use and we're going to combine them all together. But in this just this one video alone, we're literally just going to look at how we can introduce the idea of premium discount with everything that you have learned about market structure up until now. So the idea behind premium and discount is essentially buy low, sell high, which is probably a trading adage that you've heard plenty of times. Essentially, it all just boils down to how a normal business would run itself, sort of in the real world, right? A business is going to want to buy their stock, right, at low prices, and then they're going to want to sell that back to customers at a higher price than which they bought, and they will essentially lock in their profit, right? So it's the exact same thing. We're running a business, and the products that we are buying, selling, that we're trading is just simply currency, and we want to do the exact same thing. We want to buy low and we want to sell high, right? So this concept is very, very simple. It's the exact same, price action example that we were just looking at, except I have applied this premium and discount range tool here, which is basically you just draw this box from the low to the high. So in fact, what I would do is actually show you how I do this. So if you go over to the left hand side and you open this side menu, you will get something called the fib retracement at the start. So if you just add that to your favorites if you haven't already got it on there, and then you click that. Now when you first drag this out, in fact I'll show you what it will probably look like. If I change it to the default settings, you'll have this horrendous thing that looks like this, right? Now what you want to do is essentially go into your settings and change this so that only 0 is ticked, get rid of everything else, and then keep the 1, get rid of these, and then you want to get rid of those, and you only want 0, 1, and 0.5, and then I tend to get rid of the trend line, and then get rid of the prices and the levels as well, and then you can play around with the transparency there, right? So that's essentially all you want. Now you can change the colors to whatever you want, and visibility and whatnot, but essentially all you want is 0, 1, and 0.5, and then make sure the top half and the bottom half are slightly different colors. Well, even that doesn't really matter. You'll see how we use this in a second. So I just have a pre-saved template like this, reasonably neutral colors. Now the way you actually draw this tool is if we are in a bullish market, you mark out where your current swing low is and your current swing high is, so you know what range we are in. You draw the tool down to the bottom of the swing low, and then you can just draw it up to the swing high there. So that's how I'd recommend you kind of draw it, and then you can keep it on the leg of price action, and it kind of keeps your charts nice and simple so you can focus on the actual price action. But anyway, we'll talk about that in a little bit when we actually hop on the charts. But for now, I'm just going to leave this here just for the purpose of the explanation so you can kind of really see this concept of how it plays out. So obviously the higher up in the leg, right, this is going to be the more premium pricing. This is where price is at higher levels, and what often happens is price likes to pull back past the equilibrium point. So the equilibrium point is essentially the 50% level. It's the halfway point between the low and the high, and the idea is that at that halfway point, it's at complete fair value, is at the equilibrium. There's a balance between buyers and sellers at that level in terms of the fair value of the actual price. So then once we go below that equilibrium level, once we go below the halfway point, we are now anywhere in the discount level. So the idea is anywhere in this blue box below the 50% is we have cheap pricing, anywhere above it in the grey box, this is premium and expensive prices. So if we look at the previous example we're looking at, right, where we get that first initial change of character and the pullback is starting, right, and then we got this full signal here. So when we saw that change of character in our favor and then we get this little pullback, right, you could be looking for, don't know why that's not working for me, let's see, okay, anyway, but if we were looking for getting long from down here, right, then price runs a little bit in our favor, but then it ends up not working, we get a change of character and we pull back. So as you can probably see, the reason why we use this tool is because it's higher probability. If we're looking to buy, is to wait for price to come down into those discount prices, right? So as you can see here, we get the change of character. This signals that the swing run may be over and the pullback is starting. We then see that change of character in favor of the trend, right? The swing trend. So that gives us that first signal that the high low may be in place, but it turns out to be a full signal. We then get that bearish change of character, right? And it's in the premium prices. So you can, if you want to, right, look to get short here, and at minimum target the weak lows, the internal weak lows, or target the equilibrium and into the discount pricing. Exact same thing here, right? When that first initial change of character occurs, because we are in the premium, you can look to take counter trend shorts on the idea that price is going to want to pull back to at least the equilibrium, but ideally the discount pricing, okay? And then waiting for price to reach discount, right? It can prevent getting involved in those full signals prematurely, so it can increase your strike rate in catching the true swing high low forming, right? So if you wait for price to come down to this discount level, the theory is you're going to improve your probability of actually catching the move that continues the next swing run up in towards this high. So just got some very simple instructions over here on the left hand side, essentially, of what you want to do, which is identify the price leg. So essentially this whole swing leg run up here, right? This is the leg of price action, that whole swing leg, and then you are playing within this swing range, right? And then all you do is get your Fibonacci tool, and then you basically use that as your premium versus discount, and you can draw it between the low and the high, and then that will mark out the 50% level of your range. And then anywhere below the equilibrium, you're essentially buying in the discount. Anywhere above, you'll be buying or selling in the premium, okay? So if price is bullish, in this case we are in a swing bullish trend, right? It's best, you don't have to, right? But it's better in terms of increasing your probability and then stacking those in your favor to catch those larger swing moves is to wait for price to come down in here before you buy. Now you don't have to do that, right? You will see that there will be times where price will not pull back to the equilibrium or the discount. It will just pull back a little bit and it will continue going on. So we'll talk about this a little bit more in a bit when we go on the charts, but this is something that you need to test yourself. You need to collect data on. It will obviously be depending on your style of trading, how aggressive you are, how conservative you are, what pairs you are trading, and you'll gain that with experience. But as a very, very general rule, a blanket rule that would apply to everything, no matter what asset class you are trading, no matter what individual instrument you are trading, this theory will always hold water, that the lower you are buying, right, within a swing range, you're going to have that higher probability of catching the low that will actually go, right? Because you can still buy up here, but you just have to manage your expectations that it may just be a short move, right? And it might not go the whole way. So you can get in and out and be a bit more aggressive with your trade there, okay? So if you are going to take that counter trend short in this case and play that pullback, it's higher probability to do it whilst we're in the grey section, right? Whilst we're still in the premium pricing. And then obviously if we were bearish, right, so if we were with the swing trend coming down and then you wanted to play the pullback, right? You wanted to buy this pullback up here, right? Let's say that this is the EQ of this high and this low, then the counter trend longs are going to be higher probability anywhere within this section, right? Below the EQ. As soon as we start to go above the EQ and now we're in the premium price of this leg, right, that's where it's much lower probability to be buying that counter trend short, because at any point, right, that lower high could be about to go, right? So that's the general idea behind that. So if we kind of take this theory just one little last step further, now the way I've kind of drawn the premium and discount tool here is essentially how I personally draw mine in the live market. It's just a bit more of a, I guess, a minimalistic way of drawing it. I'll just quickly show you the settings. So exact same thing again, right? Just the 0, the 1 and the 0.5. But all I have showing in terms of the color is the red line there. I've just got it a little bit opaque as well. And then here, yeah, just basically have it a very, very thin line grey, but I don't have the background colors showing. So this is why it would be like that, right? But I've put that down to completely down to 0, so it's completely opaque. Or translucent, I guess would be the word, not opaque, right? I always get that mixed up. Just so it's a simple line, essentially, just so when you're in the live market and you may have a lot of drawings and other concepts that we'll be using later, it can get a little bit messy, but I don't want that to be messy. I want to see price action. I want to see what's going on. So yeah, this is just at the moment currently the way that I draw it on my charts. But yeah, do whatever works for you and makes most sense. But I just want you now to understand that obviously when we're in a bullish market, anywhere below the red line is going to be discount, anywhere above the red line is premium. So essentially the red line just represents the 50%, the halfway point, that is the equilibrium. So when we're in this bullish market, right, we know that this is the equilibrium and we're expecting price to pull back below the EQ at some point into discount prices. Whilst we're still within the premium, it's not the most high probability area to be buying. But if we want to start to trade that pullback, whilst we were above this red line, right, anywhere within this section of price action, it can still be high probability to look for those counter trend shorts. So we get that minor break of structure, that kind of first sign that we get that change of character, that we get that lower low and price may be pulling back, right? So then what we can do is what I've done here, I'll just draw it on again, is then mark this leg out, so the internal leg, right, that this substructure leg essentially, so price's movement down. And now what I want to do is I don't want to just sell here straight away, but we want to do what? It's just the exact same thing again, but kind of like fractal, is we want price to pull back into the premium of this prior leg, right? So price pulls back up to form that lower high. Now we're in the premium of this internal leg, and we're also in the premium of the swing leg, okay? So we're in the premium part of the whole swing leg, and we are now in the premium part of this internal leg, right? So we pull back into expensive prices of the internal leg, the expensive prices of the swing leg, and now this is kind of stacking more probability in our favor that going short here and playing the counter trend pullback is going to work in our favor, okay? And then we can use other concepts, right, like weak internal lows. Why is this a weak internal low? Because it never took out the last high, right? So if this starts to go down and we're short, that can be our first target at minimum. But what we can also target is for price to come down to the equilibrium and potentially further into the discount, okay? So there's some of the things that you can be thinking about, right? Starting to apply all of those concepts that we know together and just piecing them together as sort of one big puzzle, okay? And you can start to see now how price can be a bit fractal here. So we have, all of this is within the premium up here, but then we also have the premium and discount of this single leg as well. Okay, so again, just to summarize, if you're going to play counter trend shorts in a bullish market, ideally you want to only be selling whilst we are in the premium of the swing leg. And then once you have the leg and you're waiting for the pullback and you want to sell that lower high, remember our job is to sell lower highs and buy higher lows. Okay, if you want to do that, wait for that to pull back into the premium, and that again is going to increase your probability. Now, don't get me wrong, plenty of times price will just pull a little bit back and it won't go all the way up to the premium, right? And it's valid to do that. You have to work out what's in your trading plan. But at the moment, I'm just talking about what is going to increase your strike rate, what is going to be the most probable. And this is another tool that we can use, the premium versus discount, to really do that for us. Okay, so on and so forth. So at this point, this would still be in the premium of the swing leg. And again, you can mark out this leg as well, right? We've had now two, essentially, those two minor breaks of structure to the downside now. So it's giving you a bit more confirmation. We're seeing bearish order flow kick in. This potentially could be that third internal lower high. So maybe this is where you want to get short. Now you've seen enough confluence, and then you can target this weak low, or potentially down to the equilibrium, or potentially further, right? Then once we're coming down into the discount of the overall swing leg, we wait for that change of character to go in our favor to show that price is bullish. And then we don't just buy, right? As soon as we get that minor break of structure, as soon as we get the change of character, why is it not high probability to do that? Well, what do we expect after a break of structure? We expect a pullback, don't we? Where is it going to be highest probability to assume where that pullback is going to end? In the discount prices, once we get below the equilibrium, right? Once we get down into the discount, anywhere within this zone here is going to increase the probability of us not getting in too early, where it goes up a little bit and then goes deeper. Okay, so anywhere within discount prices is going to be higher probability, and we're just stacking more and more. We're just stacking more and more confluence in our favor. We're trying to tilt those probability skills in our favor as much as possible. Just applying this very, very, very simple tool, but in kind of a number of different ways, can really, really help us. And again, you see how here what the difference between the counter trend trade is that we're going to just target either the most recent week low or at least down into the discount prices. But once price is pulled all the way back into the discount, right, and we're then get the change of character that is now in favor of the swing trade, of the swing trend, I should say. So we are now bullish, right? We're in line with the overall bullish trend. So now we have the internal structure making that higher high. We're in the discount of that swing range. Now we wait for the price to pull back into the discount of this internal leg. All right, and now if we're getting long here, instead of just targeting, just this high, or maybe up into premium prices, because we are pro trend, we can then hold this with a lot more confidence and try and target this weak swing high and potentially further, right? So I am getting a little bit ahead of myself here talking about trade management, but this is, I just want you thinking about these concepts and how we're actually going to apply this, into our trading plans and into the actual real world as we dive into the charts. So with that said, we've gone through the theory now, so we'll next go and look at how we can apply this to the charts. Hopefully you guys have kind of saved down the drawings and annotations that you have done from the previous lesson on the markups in your charts, marking out your swing highs and lows, and we can now go and apply this and go and have a look and see how this can really aid us in our analysis.